What if money was never really about gold, never really about cash, never even about banks? What if the true collateral behind the modern financial system is your time? Not the hours you already worked, but the hours you haven't yet lived. Your future labor, your unborn productivity, your expected obedience to an economic system that assumes tomorrow will look like yesterday. Because at some point in history, banking quietly crossed a line. It stopped storing value and started pre-owning the future. Today, entire economies run not on money already earned, but on promises extracted from the future. Governments borrow against tax revenue that doesn't exist yet. Corporations borrow against profits not yet created. Households borrow against decades of labor they haven't worked. And when those promises break, the system doesn't fail equally. So here's the mystery we're going to unravel. How did banking transform time, labor, and futures into collateral, and why does the system now depend on keeping us permanently indebted? The answer is older than modern capitalism, more unsettling than most people realize. And once you see it, you can't unsee it. To understand how time itself became collateral, we need to go back to a world before credit dominated life. For most of human history, economic exchange was immediate. You worked, you were paid, you produced, you consumed. Debts existed, but they were personal, local, and limited. In ancient Mesopotamia, the earliest debt records were written on clay tablets. These debts were tied to harvests, seasons, and physical output. If crops failed, debts were often forgiven. In fact, many ancient societies practiced debt jubilees, mass cancellations, designed to prevent permanent servitude. Why? Because early rulers understood a dangerous truth. If debts compound faster than human labor can repay them, society collapses. Debt, left unchecked, turns citizens into serfs. But this understanding slowly eroded. As trade expanded, something subtle changed. Merchants began financing voyages that lasted years. Returns were delayed. Risk increased. To compensate, lenders demanded more control. And that's when banking made its first crucial leap. The first transformation came when time itself became monetized. Medieval banking houses in Italy, Florence, Venice, Genoa pioneered instruments that allowed money to exist across time. Bills of exchange, letters of credit, interest-bearing loans. Interest was the key innovation. Because interest doesn't just demand repayment, it demands more future labor than was originally borrowed. From that moment forward, the borrower wasn't just working to survive. They were working to satisfy a mathematical obligation, and math doesn't care about human limits. If a farmer borrowed seed grain with interest, future harvests were already partially owned. If a merchant borrowed capital, future profits were prickly. Time had become collateral, but there was still a constraint. Money itself was scarce. Gold and silver limited how much future could be pulled into the present. That constraint would not last. The next leap came with fractional reserve banking. Banks discovered they didn't need to lend money they could lend claims on money. Deposits became the base for multiple layers of lending. One unit of money could support 10, 20, or more units of credit. This wasn't just leverage. It was time extraction on an industrial scale. Because every loan assumed future repayment, every repayment assumed future labor. Every layer multiplied society's obligation to produce tomorrow. Now scale that across kingdoms. Governments realized they could finance wars by borrowing against future tax revenue. Entire populations were conscripted into debt without consent. Children were born already owing money, not directly, but structurally. Banking had moved from financing trade to colonizing time. Still, something restrained the system. Money creation was tied loosely to gold, and then that final barrier fell. The true turning point arrived in the 20th century. World wars shattered gold-backed finance. Governments needed unlimited funding. Banking needed unlimited flexibility, so the system quietly redefined money. No longer a claim on metal, but a claim on future productivity. Fiat currency was born. From this moment, money creation became limited only by confidence and compliance. Central banks issued currency backed not by gold, but by government bonds. Those bonds were promises to tax future labor. Banks used those bonds as collateral to create more credit. It was a closed loop. Future labor backs government debt. Government debt backs money creation. Money creation fuels private lending. Private lending extracts future labor. The system no longer needed savings, it needed belief. And belief held for a while. Eventually, promises multiplied faster than reality could fulfill them. This is where cracks began to show. By the late 20th century, financial markets weren't just trading goods or companies, they were trading expectations, futures, contracts, options, derivatives. These instruments didn't represent existing value, they represented anticipated value. Banks bundled mortgages, decades of household labor into securities. Those securities were leveraged, releveraged, and insured with more promises. The same future labor was sold multiple times. When housing prices rose, the illusion held. When they stopped rising, the math broke. 2008 wasn't a housing crisis, it was a future collateral crisis. The system had promised more future labor than society could deliver. And when collapse threatened, something revealing happened. Banks were rescued, markets were stabilized, debt was preserved. But the cost wasn't eliminated. It was shifted forward. Interest rates were crushed to zero, encouraging even more borrowing. Asset prices inflated, rewarding those who already owned assets. Wages stagnated, while productivity soared. Households didn't escape debt, they became dependent on it. Student loans tied education to decades of repayment. Mortgages extended working lives. Credit cards smoothed survival while deepening obligation. The system adapted not by fixing the problem, but by normalizing permanent debt. Time wasn't just collateral anymore. It was pre-allocated. Every crisis brings reforms, more regulation, better risk models, stress tests. But none of these address the core issue. Because the system isn't broken, it's working as designed. Banking today doesn't primarily allocate capital, it allocates futures. Those with assets can borrow cheaply against them, expanding ownership. Those without assets borrow expensively against labor, locking themselves into repayment. Attempts to fix inequality without changing debt dynamics fail because debt predefines outcomes. Even digital currencies and fintech often replicate the same structure faster, more automated, but still few. The question is never whether debt grows. The question is who owns the future it claims. Look around today. Governments carry debt exceeding annual economic output. Corporations issue bonds to buy back stock rather than invest. Young workers delay families because future income is already spoken for. Artificial intelligence promises productivity gains, yet wages remain flat. Why? Because increased productivity often services existing debt claims, not human well-being. Even inflation plays a role. It quietly transfers value from savers and workers to debtors and asset holders, reshaping who controls time. The same pattern repeats. Expand credit, pull future value forward, delay consequences, socialize losses, repeat. History doesn't repeat, but financial structures rhyme. So what did banking actually do? It turned time into a commodity. It turned labor into collateral. It turned the future into a balance sheet entry. And once a system depends on future extraction to survive, it cannot stop, only accelerate, until something breaks. The danger isn't debt itself. The danger is when debt grows faster than human life can repay. 3 takeaways. First, money today is not neutral. It carries embedded claims on future behavior. Understanding this changes how you see work, debt, and policy. Second, inequality isn't just about income, it's about who owns future time. Assets capture tomorrow, labor sells it. Third, every financial innovation should be judged by one question: does it serve human life or mortgage it? If the future is already collateralized, what happens when people refuse to pledge it? What happens when demographics shrink, productivity stalls, or belief fades? History suggests systems that overclaim the future eventually face a reckoning, not because people rebel, but because math does. The question isn't whether change comes, it's who absorbs the cost when it does. If this video changed how you think about money, debt, or time itself, let me know in the comments. Subscribe if you want more deep, uncomfortable explanations of how financial systems really work, beyond headlines and hype. Because the most powerful structures in the world don't control money, they control tomorrow. And understanding that is the first step toward reclaiming it.